Hey everyone, and welcome back to Keeping Tabs, where we get real about real estate. I'm your co-host, Zach Viscomi, and we're excited that you're here. In today's episode, we're going to be diving into the world of home loans, and trust me, this is a conversation every buyer should hear.
So one of my favorite lenders, I hope my other ones aren't watching, is with us today. We invited Jake Kolen from Prosperity Mortgage. Jake and I have done many transactions together. There's many reasons why I value Jake and trust his skills and trust his ability to bring our clients to the closing table. So today we've invited him to talk about money, because at the end of the day, money is what we need to purchase the house. So the realtors can find it for you, but we need the lenders to back it. So we've invited Jake today.
Thanks. Tabitha, thank you so much for having me join you on your podcast here. And Zach, it's a pleasure. It's an honor to be able to work with you guys. Tabitha, especially, you have a great way about how you handle real estate transactions. And it's one of my favorite things about working with you is how professional you are and how hard you fight for your clients on the buy side and on the sell side. And so from my perspective, I've been in lending for a little over 20 years. I grew up in a real estate family, so I'm used to the conversations at the dinner table of how come things didn't sell or settle, or can you believe that the basement filled with water 3 days before closing, and how you solve these kind of things. So I kind of grew up at the foot of the real estate model and found my way into lending. For me, I think the best part about what I do is it's similar to what you do. You're helping somebody or a family get to the next step of what they want to do in life. Maybe they're in an apartment and they haven't purchased their first home ever, and they want that first home. What I do is, just in combination with you, Tab, is to help that person or family find the solutions to get there. And that's the joy of why I'm in this whole business piece. The joy that I find is the satisfaction of getting somebody or a family to that next step. And there are different varieties. There are little homes, there are big homes, there are vacation homes. It's trite, but it's helping people achieve the American dream of home ownership. So the flag in the background is not really just a prop. It's something that really drives me. It's a goal. People want to achieve more. And Tabitha, you do it. You help them get there. And being on your team that's the way that I can help those people get to that next step. So that's the fun part. It really is helping people.
Jake, we've seen clients where they're not ready today, right? I've introduced you to clients that are not ready today, but it's getting them to being ready. And that's very rewarding, right? Like, I think we've helped a couple clients out where their credit wasn't in line, or they needed to stay there at their jobs a little bit longer. And then in 6 months, we're ready to go, or 8 months, or whatever it takes. And that's the joy of walking people through this. Every price point we service, we've done it all, and it's just helping those families. I think we've had a lot of, I was thinking about this at the end of my close last year, of how many single women I helped buy homes last year in 2024, and it's still pretty good for 2025. So that's a huge venture that a single woman can purchase their own home, and that's been a joy of mine to help people. So Jake's been part of a lot of those transactions and helping people. So it takes a team. And I think when a lot of people come to me to start shopping, some people are pre-approved, some people are not. So some people just went online and they grabbed a pre-approval from a bank or whatever. And I always stress the importance of, you got to shop local. Shopping local makes a huge impact on this market. We're still in a competitive market in most areas that are surrounding Philadelphia and in Philadelphia. So shopping local sometimes helps you get your loan or your offer accepted. So that's it's really huge, and people don't realize that. So that's why I have a local lender with us today.
Yeah, and I think, it's important for the listener to understand too. It's whether you're a first-time home buyer or you're just looking to be refreshed on this process. I mean, the goal of this episode and this podcast is to make sure that you have a better understanding of what your options are, because the reality is there's a lot of different options that we'll even talk about today with Jake. And so I think that's kind of what we'll jump into and talk more about. What are the opportunities that are out there, and how can they impact you, and which one is the right choice for your current situation?
Yeah. So Jake, let's talk about what today's interest rate is. And everyone wants to know what the interest rate is today.
So the interest rates today, people are maybe a little bit gun shy. Today we're beginning early August, and interest rates are in the middle sixes, high sixes, depending on a lot of different factors. It can be credit score has an impact, loan amount has an impact, the loan type has an impact, and the down payment has some impact. The type of property has an impact, all on the different rates. But generally, when somebody says, what are the rates today? Right now, we're looking in the middle to high sixes. And though it's not where we were in 2000 or in 2020, where we were in the twos and threes, people now would love to have a number that's in the twos or threes or fours. When you look at the all-time history of mortgages and tracking where rates are, if we're in the 6.5 to 7 range, that's kind of what the average of where things have been over a 40-year period. We had that beautiful little dip in 2020, where honestly we were in the twos on some mortgages, and really the system couldn't sustain that. And so now we're middle sixes. Maybe we'll see a little bit of a decrease in that with some of the changes in the administration, the present administration. We don't really know that. But what we do know is property values continue to climb in our area. We're in the Philadelphia community, and generally the property values are stable and consistent. We don't see the huge variations that you might see maybe in California or Vegas or Florida. Our area is just generally pretty stable, and so people still need to buy and sell homes. With the rates in the middle sixes, that's about where they were when I started in the business a little bit more than 20 years ago. And people have purchased homes all through that time. So with the rates where they are, we still have some great programs to help people qualify to be able to buy their either first home or their next home.
And what do you say to people? Because we hear all the time, we'll have, some people where they'll have opinionated parents or something, and the rate's too high, What do you say to those people when they say the rate's too high, don't shop yet?
Well, it may be too high, but waiting also has a cost. And so if you purchase a home now, you get the benefit of the home ownership, the joy of owning your own home. You start to build up equity in your home. And let's say, just for discussion purposes, if the rate is 6.5%, you're not necessarily stuck with that for 30 years. If we see that the market improves from 6.5 to below 6 into the fives, you're going to hear from me and my team to say, hey, let's look at a refinance and put you into something that's a little bit better. But in the meantime, each month that you're making a mortgage payment, you're building a little bit more and a little bit more and a little bit more of equity in your home. And equity, real estate equity, long term, is one of the keys to financial stability, longer term, right? So if the rates are too high now, waiting might mean that the sale price of the home goes up. So if you wait a year and the rates go from 6.5 to 5.5, in a year, the sale price might go from 400 to 430 or 440. And so the savings that you might get on a reduced interest rate, if you think the rates will get better in a year, which we can't guarantee, if you think you're going to get a better rate, the price that you might pay might be higher. And so ultimately, people have purchased homes with rates in the sixes and sevens. Frankly, my dad in the 1980s, our dinner conversation was, the rates are 18%. And as a kid, I don't know what that means, but I know now that's really expensive. So comparatively, and people were still buying houses and they were building equity. And when the opportunity came about, they refinanced and put themselves into a little bit better payment and continued to build that real estate equity, the growth in equity. And that's a big piece of the conversation. So someone says that the rates are too high. They're not as good as they were 5 years ago, sure, but they are pretty consistent with what we've seen over a longer term period. And those parents, if they're saying that the rates are high, I would ask them what their rate was when they first purchased their home, and I would guarantee it's in around that.
Yeah, it's just because we were so spoiled for so long with low rates that it just seems crazy right now. But when you look at the rental market and you look at what rents are going for, and people's, I'm helping renters, 3,000 a month, 3,500 a month, 4,000 a month. Like if you have that amount of money to pay someone else's mortgage off, why not try to see if you can have your own mortgage for that? And again, not everyone's ready right now to be a homeowner. And I rented for many moons for many reasons. One reason, because I was always self-employed. So it took a lot longer for me to be able to qualify, as a self-employed person. So I probably wanted to buy a lot earlier or sooner than I did because it took longer, but everybody has the right time to do it. And I've refied. I think two of my houses I refied and was fortunate to save a couple bucks. That was nice, a nice time to have like $100 or $150 savings per month when you refied. So all good things.
A big part of what we do in that preparation, Tabitha, is you had said maybe it's not the right time for a client to buy right now. And part of the consulting part of what I do with the clients is to look at their overall financial picture and say, okay, you might be strong on income, you have stable employment, and you might have good assets or possible family gift funds that might be able to help with your purchase. But we need to get that credit stuff fixed to get you into the best tier for financing. And so it's like planting seeds. Some of them grow quickly and some of them take a little bit longer to grow, but it's all part of the process. And you mentioned it earlier, Tabitha, that the joy, the fun, the piece that really makes what we do exciting is helping that person do it. They did it. We can't fix their credit for them. We can coach them. You can't force them to buy a home. They buy the home when they're ready. But that part of building their credit or fixing their financial picture, that's a part of that whole consult that I do with the clients when they come my way.
Yeah, and that's part of my consult before I send them to you. We really start talking about finances in general, and what I always before we really get down to the nitty gritty is I always talk to clients and say, you want some type of reserve too, right? You don't want to clear out your accounts and just get your house because there's a lot of what ifs. What if will happen once you're a homeowner? And so we have that conversation with my clients and we talk about, me and the client, like where the finances at. Do you feel comfortable in this type of monthly payment? Are you going to have a cushion? Because you don't want to be house poor. There's nothing worse than being house poor. So we have that conversation because at the end of the day, I want someone to be joyful in purchasing their house and not have regrets that they just made this purchase that it's just too much for them and they can't handle. So we talk about that. So Jake, what are you writing the most type of loans? Are they conventional? Are they FHA?
So the market has gotten exciting, I guess, in mortgage world. There are some standard mortgages that we do all the time. A conventional loan, I'll give you just a quick list. A conventional loan, an FHA loan, a VA loan, a Veterans Administration loan, a USDA loan. That tends to be, it's not like a farm loan, but it's more of a rural type of a loan. A state bond loan, PHFA in our area, Pennsylvania Housing Finance Agency, jumbo loans. And then the part that's maybe somewhat newer, more exciting that a lot of buyers don't know is the non-QM loans, the non-qualified mortgage loans. And it sounds like a strange name. It's just really the creative financing options. So you might not, if you're self-employed, you might not need to wait the normal 2 years. We might be able to do financing after a year of you being self-employed. That's kind of a cool thing. Or an asset qualifier. If somebody is a bit older and they don't have a job, but they have strong assets, we can use those assets to qualify. And there are a couple others that we'll talk about. So the general gist of what we do, probably 80% is a conventional loan. That's the conventional financing, which is not a government insured loan. It's backed by Fannie Mae and Freddie Mac. Those are the two overarching entities that create the lending rules for buyers. Some of the lending rules might say you have to have stable income. You have to have 2 years of work history, or you have to have a certain amount for down payment or a certain credit score. The credit scores tend to be a little bit more important on a conventional loan than some of the other loans that we do. But generally speaking, I think the most of what we do is probably about 80% is the conventional financing.
And can you explain, like, debt to income ratios and the importance of that on a conventional mortgage, what they're looking for?
In general, when a client comes to me, I have always kind of said we talk about the 4 quarters to get the dollars. And so there's income, that's important, assets, money that they have for down payment and closing costs, income, assets, debts, so car loans, student loans, credit card debts, and credit score. So those are the 4 critical pieces or important pieces that the buyer needs to have in decent shape to qualify. And you mentioned a debt to income ratio. Typically, what a debt to income ratio is for qualifying, let's say just easy math. If the client makes $1,000 a month, that's not huge, that's $12,000 a year, but for easy math, if they make $1,000 a month, they can borrow, including all of their debts, so car loans and student loans and monthly credit card debt, they can borrow up to about 45% of that gross monthly income. And so if they made $10,000 a month, the max that they could qualify for is about $4,500. If they have a car loan, that's $500 a month, and a student loan, that's $500 a month. That $4,500 now is 45 minus the debts is now $3,500. So generally speaking, it's about 45% of the gross monthly income if you're salaried, not self-employed. About 45% of the gross monthly income is the debt to income ratio where we want to be. More than that moves in. Lenders don't like to go above that because that becomes a high risk loan. And frankly, the high risk, it's high risk to the buyer. They may have a hard time making their monthly payments if their mortgage payment, just like you said a little bit earlier, Tabitha, house poor. If they are overwhelmed with a monthly payment, they're not going to be able to pay for utilities and pay for food and things like that that they need to survive. They're going to have a hard time making that mortgage payment. 45% tends to be the general rule. There are some more restrictive loans that have lower numbers and some that have higher numbers too. But 45 is a good general target for debt to income ratio for qualifying.
And for conventional, a lot of what I'm finding, a lot of my clients, I have a lot of healthcare workers that are hourly, right? So when someone's an hourly employee, how are you guys qualifying them?
That's a great question. So the different types of employment that we typically see, the easiest one, the most straightforward, is a salaried employee. A salaried employee gets the same amount every week or every 2 weeks or every month. And so if somebody makes, their salary is $60,000 a year, they make $5,000 a month. That's pretty easy math for us to do that calculation. And that's whether they miss a day of work or whether they work extra hours or they generally work a 40-hour week. That's the easiest way, is a salaried employee. And then as it gets a little bit more complicated, if they're hourly and they're working, let's say 32 hours and then 42 hours and then the next week 50 hours and then back to 37 hours, so the number bounces around a bit, the investors, the lenders want to see more stable income over a longer period of time. So generally speaking, if you're hourly and it's a variable hourly, not just straight 40, if we look at a pay stub and we see 40 hours consistently every week or every 80 hours every 2 weeks, and that's consistent, we can use that. If they're variable, the lenders want to see probably about 12 months of time of that variable income so that they can say on average, this is what the client this is what they're confident saying the client could qualify for based on this in terms of hours. Here's what we can give them credit for income. So hourly employees, things have gotten a little tougher for them because the lenders want to see a longer term of stability to be able to average that income confidently.
And how long should I be at my job before I am applying for a mortgage?
Well, if I say right away, let's find out right away, because maybe there are different pieces to your financial picture that we will uncover through our interview with them. Let's find out right away. And if we say, okay, that maybe the client doesn't know that it's important to work consistent 40 hours a week. If they're in a variable hour employment, it may take them 12 months to get that stability, but let's find out that in the beginning so that we can give them that longer term plan. Should they apply? Will they likely get a loan if they're working 32 hours and then 42 hours and then 10 hours and 60 hours? Not if they just start that position. But if the employer will say, hey, we're going to guarantee that they're going to be getting 40 hours a week, and their pay stubs for a year-to-date pay stub start to match that, sometimes we can do exceptions and get that approved based on the employer's level of confidence in those set hours, a minimum number of hours that they're going to be working.
And that's when you ask me to have clients get letters from their employers, right, to verify all that stuff. So your employers will be contacted most likely in that situation. So no hiding house buying on your employer.
For people that want to keep it a secret, their best thing is to be a salaried employee. If they're an hourly employee, unfortunately, their employer is probably going to know that we're asking some questions about, and you confirm that this is the number of hours that they're going to work.
Right.
So be nice to your boss as best you can so that they can write you a nice letter.
And they can pick up the phone when the lenders are calling and asking questions for them.
That definitely helps. Yeah, that's important.
So you're talking about, and I heard a few things in here. Obviously, it's good to get started early so that you can have a plan for what you may need to accomplish. And you mentioned earlier about the 4 quarters to the dollar that sort of make up all the things that people really need in order to qualify for the best rate. So can you talk a little bit more about what people can do if they're in that phase of being able to build their 4 quarters to actually qualify then for better rates?
Yeah, absolutely. Zach, that's a great question. It's part of that analysis, that interview process that we do with the clients. When Tabitha sends somebody over to me, I'll review these pieces. For income, if they're in a salary position, that's great. Keep your job. Don't quit your job. Keep working and try not to have any variations. If you're hourly, try to make sure that you're as consistent as you can. Try not to miss time. Try to make sure that your hourly average is consistent. It might sound, I guess, easier said than done, but if you take off a month because you want to take a vacation and you're an hourly employee, that can have some impact on your average income over the year. On income, we need to have stability. On assets, the more you save, the stronger you are as a buyer to be able to get to the next, to be able to cover your down payment and closing costs. Again, might sound easier said than done, but save money as much as you can. Save, and try to keep compiling that. If you have a family member that a parent might be, or a grandparent might be able to give you a gift to help with your purchase, that's something that we'll talk about too. Check with your family. Maybe you have
Never had that family.
Maybe you have a rich uncle that can't wait to help you succeed.
I could use one of those.
Me too. I would love one of those.
That would be.
We're going to start cold calling our family members.
Yeah. So that's on the assets. Income and assets are relatively basic. When it comes to debts, believe it or not, sometimes paying off an installment debt, a car loan, actually has a negative impact on your credit score because it stops hopefully a positive payment history. It brings that to an end. And so your credit score, if you paid off a car loan, you say, I just want to get rid of that payment. Well, that stops being a positively reported item on your credit score. on your credit report. And so maybe keeping that payment in place is okay. If you have credit cards, we always want to see that your credit card balances, you try to keep them at 30% or less of the limit. So if your credit card, your Chase card, your Bank of America card, Macy's card, if it has $1,000 limit, try not to spend more than $300 on that. Try to keep it below 30%. That shows that you're not stretching your budget too much. Also, conversely, if you have credit cards and you don't use them at all, don't close them. Just take one and use it to buy a cup of coffee every month. Show activity on that credit card because it shows on the credit report it's a positive credit item. It's a positively reported credit transaction. You've used your card, at the end of the month you paid it off. You used it, you paid it off. And what that does is if you have one credit card and you make 12 and you have 12 months of payments on time, you have 12 months of history for there. If you have 3 credit cards and you've paid them on time, now you have 36 months or 36 on-time payments. That's a wider base and more stable for your credit history and your credit report. So credit agencies will look at the usage, the number of cards, and making sure that they're all on time. If you have 6 credit cards, I don't think you necessarily need that many. But if you have 6 credit cards and you use them once for gas and one for groceries and one for your coffee, you use that and pay it off every month. At the end of a year, you're going to have 72 on-time payments, assuming that you do this. That wide base or wide foundation for a credit report is really going to push your credit score higher. And those are some of the things that people think, well, I don't use any credit card, so I should have great credit. But you haven't shown a history of using credit, allowable credit, and paying that off. And so when you use it, even if it's the tiniest little bit, use it and pay it. Use it and pay it. That's going to continually build your wider base or foundation for credit. If you use a credit card, let's say for a vacation or something like that, and you run it up to $900 on a $1,000 limit, you're now maxing out that card. That can have some negative impact on your credit score if that's the only card you have. But if you have multiples, and again, you're using and paying all the way through, that creates more stability so that one card or one late payment somewhere is not going to tank your credit. Credit cards, if you can, below 30% of the limit, use them and pay them each month, right? And maybe don't pay off all the way your installment debts, even if you have the assets to do it. You can, after you purchase the home, you can do whatever you want. Pay them off if you want so that you can breathe easier. But leading up to that, I would say don't pay them off so that we can get a better credit score. One of the neat things that has become more common in our industry is that we can do something called a soft credit pull. A soft credit pull allows us kind of a peek into what the credit report is without the impact or negative impact of a hard credit pull. A lot of people read online, I don't want my credit pulled because a hard credit pull is going to tank my credit. It's not really. It's probably 3 to 5 points when you do a hard credit run. But if you have excellent credit, 3 to 5 points is not a big deal. We would like to know that kind of in the beginning what your credit score is, so that if your credit score is 600, we know we have to do some work on that. And so it's important to know then we can maybe get that 600 up to a 640 or 600 to a 660, because that can put you into some better loan programs compared to a 600 credit score. So part of that interview or consult that we do with the clients is when we do a soft credit pull, we can kind of peek in to their credit, see what they have, and coach them a little bit. We're not a credit repair company, but I've been doing this long enough that I have a really good feel for, okay, let's get this balance down. Let's make sure that you may not be aware that your Macy's card is late for the last 3 months. So make sure you bring that to current. So I'll coach them through some of the different things that they can do to boost that credit score. And then once they get under contract on a property, then we do a firm credit run. And that's the credit report that sticks with the file. And usually what we see is if the clients work on repairing some of those items or putting themselves in a little better position, we see a nice boost in their credit score. And the difference between a 640 credit score and a 740 credit score on interest rates, in some cases, can be as much as 1% of an interest rate. Maybe not quite that much, maybe 3/4 of a point, but it can be significant. And it also can impact your credit score, can impact something called mortgage insurance. If you don't put 20% down on a purchase, your loan will have mortgage insurance. That mortgage insurance doesn't protect you as the buyer, it protects the lender who's giving you the money. And so the mortgage insurance calculation is based on a couple of different things, but credit score is one of them. The better the credit score, the lower your payment. In a couple of different ways, like you had asked about the 4/4, the income, the assets, the debts, knocking them down, and the credit. Part of what I'll do with the client is to coach them to say, let's get that stuff wider base or history and bring those balances under that 30% if we can.
And Jake, I don't know if you have your calculator on you, but just out of curiosity, at a $500,000 price point of a house,
Okay.
and if I have okay credit and excellent credit, and I could save 1%, what is that savings per month approximately? If I can get a mortgage interest rate from 6 instead of 7%, what would that approximate to a monthly cost?
You might see something in the 200 to 250 range in terms of a monthly savings.
Yeah.
So it's significant. 200 a month is 2,400 a year. And over the lifetime, interest you're not paying, you could use for other things, your vacation, your food for the house, repairing, putting a deck on, or things like that. So roughly maybe 200 to 250 on a 1% difference on a 500 loan.
Okay. Now, the other most, I would say, popular loan that we see a lot is the FHA loan. So can you talk a little bit about why someone would go FHA versus conventional?
Sure. So the FHA is probably the second most common loan that we do. FHA does not stand for First Time Homebuyer Association. It's the Federal
A lot of
Housing.
people think that. Yeah.
The Federal Housing Administration. It's a government-backed loan. And so the government is saying to the lenders, if we create this loan and the buyers don't pay, the government is insuring or backing that loan and will essentially reimburse the lender if the buyer doesn't pay. The buyers that would pick an FHA loan may have, so FHA loan has some really good points and some points that people don't love as much. And what's really nice about an FHA loan is if your credit is not pristine, if you're in the middle sixes or low sixes, we can use an FHA loan and they don't punish you or penalize you on the interest rate. You still get a very nice interest rate. And they're very forgiving on credit. So if you've had bankruptcies or foreclosures or things like that, the FHA loan is a loan that allows you to get a new mortgage faster than a conventional loan or a privately backed loan, conventional loan. So FHA is more forgiving on credit. They allow a small down payment as little as 3.5% of the sale price on a home. So that's pretty nice if the buyer is tight on cash, right? So if they're not perfectly fiscally fit, if they don't have super credit and they don't have a whole lot of cash saved, the FHA loan can be a really nice route to get them into their home. Why people might not like FHA loans is because they have two things that are related to the payment. They have an upfront mortgage insurance premium. That's a fee that's charged to the buyer and it's added to their loan, right? So if their base loan is X, their add-on to that is that FHA upfront mortgage insurance premium. So it's an added fee that the buyer pays. They don't necessarily feel it because it's a small percentage of the total loan amount, and it's added to the loan. It's not cash that they bring to the table. Where they see another portion is the mortgage insurance premium. And so that's the piece that they see on their monthly payment. If they're paying principal and interest plus taxes plus home insurance, State Farm, Allstate, Trident Insurance, Geico, any of those, that's home insurance. Plus the next piece is mortgage insurance. The mortgage insurance is the piece that the buyer pays to the lender as part of their total payment, the PITI, the pity payment, right? Sounds a little funky, but the principal, interest, taxes, and insurances payment. The mortgage insurance is that extra premium that they pay to the lender in case the buyer doesn't pay. And so FHA has a mortgage insurance premium that's on for the life of the loan, for most of the loans that they do. When the buyer gets that loan, they might not love it, but what we encourage them to do is, if the reason they got the FHA loan is because of their credit, let's work on the credit. Let's build that up. And then at some point, if we can refinance and maybe that mortgage insurance can go away, that can improve your payment further down the road. But at least it helps you get into the home first. There's one other area that people generally, buyers love this, but sellers might not. They think that an FHA appraisal is a lot more restrictive than a conventional appraisal. When we do a purchase on a home, we send somebody out, an appraiser, out to the property to verify that the property's worth what the buyers are paying for it and what the lenders are lending on it. When the appraiser for an FHA loan goes through, conventional loan appraisers do the same thing, but maybe just not to the same extreme. FHA appraisers are looking for health and safety issues. First, they want to make sure it's worth it. It's worth what they're paying for it. So if it's a home on one side of the street that's 3 bedrooms, 2 bath, and the home just sold across the street 2 weeks ago is a 3 bedrooms, 2 bath, and they're similar, they're comparable, they're going to say that those homes should be about the same value. Value is one piece, but then on the FHA appraiser, they'll look and say, okay, health and safety issues. Are there any? If it's an older home, is there peeling paint? Maybe it's lead paint chips that they're concerned about. So they'll look for health and safety if there are tripping hazards or cracked windows or moisture in the basement or things like that. Those are some things that an FHA appraiser might look for. And most times that stuff has to be fixed. Hand railings to the basement is a bigger thing that we're seeing now. Most of the time, those things have to be fixed prior to closing. On a conventional loan, sometimes that doesn't have to be fixed prior to closing. It can be fixed after closing. Where a seller might, in the past, used to be afraid of taking an FHA loan because of those pieces, because of the appraiser maybe being a little bit tougher. It's maybe not as bad now because the conventional appraisers are also asking for if they see health and safety issues. But so those are some of the negatives on an FHA loan. Sellers don't think they're as attractive and they're afraid of it. That's part of what we do, is try to educate the listing agents to say, listen, it's a good loan, the buyers are in good shape, and as long as the house is in relatively good shape, we shouldn't have really too much of an issue. So FHA is great for credit challenged people, income challenged people, or asset challenged people. They also allow a larger seller credit than a conventional loan. So sometimes if the buyer doesn't have money to use for down, or much money for down payment and closing, they can say, hey, we're going to build this transaction, and ask the sellers to help pay for some of the closing costs. And FHA allows a larger amount, 6% of the sale price, to be as a seller credit to help with the buyers buying the home. Now, many agents will say, we're not doing a lot of seller credits in this market. But I think as things somewhat stabilize, and it feels like the market is now sort of evening out, where it was very heavily seller favored in the balance. Now, there's maybe a few more houses on the market and houses might be sitting a little bit longer. The buyers have a little bit more ability to ask for some seller help to be able to get through that transaction. So a nice thing on the FHA is that has that higher amount allowable to help the buyers be able to complete the transaction. Those are some.
Yeah, we went years for no seller's assist at all, right? Like it was tough for the buyers. But I think I have 2 buyers under contract right now, and one's getting a 6% seller's assist and one's getting a 3%. So they're out there. It just sometimes takes a little bit longer to find, but it's not impossible to find like it was a couple of years ago. It was much harder. So that's definitely a perk. That I know that I help a lot of first-time home buyers that might not have the assets to bring to the table, but their income is there. So that seller's assist really is so helpful, if a seller is willing to do it. And a lot of times these sellers now have a lot of equity in their house. The market's hot. So for some of them, it's really not a problem. Now, can we talk about A lot of people now we're talking about jumbo loans, or what's the max amount that you can get on some of these loans?
Sure. So some of the different varying programs have income or uh, loan limits. FHA, I believe, is right around 600. I think it's 595, 594, 500 in our area,
Okay.
the southeastern Pennsylvania area, 594, 500. And so if you're buying something with an FHA loan, you might be in a 615 or 620 sale price, and you need 3.5% for down payment. So your loan is about in that 594 limit. On a conventional loan, the upper limit before it moves into something called a jumbo loan, jumbo, think bigger, jumbo loan, is 806 500. So a conventional loan, you can go up to 806 500. And believe it or not, if you're a first time home buyer, you can borrow 97% of your purchase price with a loan. You can put as little as 3% down if you're a first time home buyer. And so that means, frankly, if it's 806 500, you're somewhere in the 830-ish range for what your purchase price could be, and still be able to put as little as 3% down for that transaction. So if we go above 806 500, now we're calling it a jumbo loan. And there are some specific investors, and they have maybe tighter requirements, higher expectations of the qualified buyer. So they want buyers to have a higher credit score because, frankly, they're borrowing more. The banks are leveraging more, putting more on the table. So they want to make sure the people that are taking that loan are more qualified than a smaller loan buyer. And so they want to have strong credit. Sometimes they require that you have credit reserves or asset reserves in their accounts. They don't want you to skid to a stop and just have enough dollars to get to closing. But God forbid you have some kind of a work issue or you're out of work for a little bit after the purchase. They don't want the whole transaction or the whole loan to collapse. So they want to see that you have some cushion or reserves, post closing assets. So jumbo loans will have some higher requirements, lower requirements on debt to income ratio. So most times they're limited to about 43% instead of what we were talking about before of that 45% debt to income ratio. Most jumbo investors are about 43% as their max of what they'll do. And then they have some other requirements. If you're self-employed, they dig a little deeper on that.
And interest rates, are they comparable to a conventional?
It used to be, I guess, some years ago that jumbo loans were always about 0.25% higher than a conventional loan. Right now, there are more variable numbers on that. Frankly, there's a jumbo lender, investor that we're working with that is scoring better than a conventional loan. So if the buyer is properly qualified, that's a better way to go if that's the type of loan that they need. Generally speaking, most of the jumbo investors are a little bit higher, but we do have some that will price things a little bit better. And I think most of that is they want to pull in some business. If they pull in some business and they get busy, then maybe they raise their rates to slow the flow of loans going to them. When they get slow, they'll tend to lower their rates a little bit. They're driven not as much by the economy, not quite as much by the economy as the conventional Fannie Mae, Freddie Mac loans, the non-jumbo loans. Their interest rates are a lot of times based on what their investor profile internally from that bank or that investment company, what their desire or demand is for financing. So it's a little bit funky and it's a deeper dive into how the rates are impacted by different economic information. But generally speaking, you have to be on a jumbo loan. You might be you'll likely need a little bit more of a down payment. You're probably into the 5 to 10%, more likely 10 and 20%. It's going to get you a better rate on the jumbo loans when you're looking at comparisons of what's good, what's better, and what gets you the best.
We didn't even talk about VA loans. So can
So
you explain the VA loan?
yes, so VA loans, and USDA loans are two of the loans that we have that are, you can do what they call 100% financing on the property. So VA loan, a Veterans Administration loan, for those who have served in the military. I'll rattle off all the normal stuff: Army, Navy, Air Force, Marines, National Guard. Those are all some of the ones that fit in that profile. If you're active duty or you are now out of the military but you've served, we ask the clients to provide something called a certificate of eligibility. And what that is they're basically the VA, the Veterans Administration, saying, we'll give you a loan as long as you meet their normal parameters. You've qualified based on your service history to the country. What's really nice about that is if you borrow 100% on a VA loan, you don't have mortgage insurance. The VA basically absorbs that cost. The buyer pays something called a VA funding fee in most cases, unless then maybe they have a disability and they have an exemption for that. But they'll pay a VA funding fee that, again, similar to the FHA mortgage insurance premium, it's added to the loan. Borrower, the veteran, doesn't really feel that in there. They don't feel it so much because it's built into the loan. They're not bringing that cash to the table. But it's a fantastic program. We waive our fees on the lending side for the VA loan as a thank you to them for their service to the country. A VA loan, if you're going to have two people on the loan, you have to be a married couple. You can't be somebody you're dating, fiance. You have to be married. Very rare cases where you don't, but essentially you have to be married to be on a VA loan. That's some of the little more detailed stuff that we get into for the clients on that.
I've got a question about that too, and thanks for what you do with veterans. Obviously, being a veteran myself, I love to hear that. But
thank you, Zach.
Yeah, so I've got a question here that I think maybe the audience would be thinking too. And obviously you've got buyers who are looking at these different options, but then you've got sellers who are going to be getting offers from these different options too. And so how do we make those decisions, right? So obviously you've gone through the decisions really as the buyer on which loan makes the most sense, but then how is the seller, because you're saying there's some perceived negativity in some of these, but they're really not there. They end up getting what they want anyway. So can you kind of dispel maybe some of the misunderstandings that people have when they're looking at these different offers laid out in front of them?
Sure. The VA loan will fall similarly with the FHA loan, where the appraiser will go through and look for health and safety issues that their job essentially is to protect the borrower, to make sure the borrower is not getting in over their head on a home purchase. But frankly, if the house is in decent shape, the VA loan is a great loan. Once we run their information, the veteran's information, through our system, and we get what we call an approved eligible, or a green light, essentially. Red light or green light is the easiest way. Once we get the green light, as long as the buyer's information matches up to what we have in the application, their income, their assets, their debts, and credit, that's a good loan. And we're going to get to the settlement table with that. The appraisal is still important. The property has to appraise on a VA loan if they're doing 100% financing. Let's say they're buying something for the contract says 300. The property has to appraise for 300. If it doesn't, the VA loan gives the buyer a chance to back out of that transaction if they want to. Sometimes they don't want to back out of the transaction if the appraisal comes in low, and you negotiate back and forth with the sellers, or the buyer just agrees to come up with the difference if there's a shortfall, if they have the funds to do that. But the VA loan and the FHA loan are terrific loans. And again, once we get them through our system and get the green light, it's a really great way to go. And the sellers shouldn't have concerns or fears about taking that kind of a loan, because, as I said, it's still a great loan. We'll just need the appraisal to come in, and we're in good shape.
Thank you.
A question I get a lot where I might have a couple that's purchasing a house, and one person has great credit, the other person doesn't have great credit. And there's a conception that, we just mix the credit together and we get an average. That's what people come to me. Aren't we going to be in the middle somewhere? And it's not, right? They're going to go off the lowest credit, correct?
That's correct, Tabitha. When we look at joint, two people applying for a loan, or 3 people, 4 people, kids and their parents maybe sometimes co-signing on a loan, which we can do. Lenders, what we do is we take 3 scores, Equifax, TransUnion, and Experian, and look at what the middle score is. So let's say the scores are 700, 698, 650. They don't average those. They'll take the middle score, which in that scenario, 698. That's that borrower's middle score. That's their loan score. If the other borrower has 750, 760, 770, and they're on the same loan, we're using the lesser of the two. Whoever has the lower of the 2 credit scores, not average, but whoever has the lower of the 2 credit scores, that's the loan score. So sometimes we have it that one of the buyers has not really great credit. Let's say in the middle 500s, that's tough to find some financing. And the other buyer might have a 700 credit score. Well, we're going to use the 500 credit score, and that's going to be hard to get financing. In those cases, sometimes we've taken those people off the loan. They can still participate in the purchase. Maybe they have assets that they can, we call it gifting the buyer for. If the person with that 700 credit qualifies, if their income is enough to qualify for the loan. But if they're doing that average, they're going to take the middle score of the lesser, whichever score is the lower, middle score, that's the loan score that lenders use in a transaction.
We could talk forever, but we're going to try to get through some of these other things that I hear, at least in the southeastern part of Pennsylvania, a lot, which is first-time home buyer grants and programs. What's out there? What's available for me if I'm a first-time home buyer?
Yeah, Tabitha, that's a great question. It's probably the most asked question when I start the conversations with buyers. And
it's give me some money. Give me some money.
Some help. Can I get some help? Can I get some money? And the answer is there are a lot of different programs that are available. Part of that consult that we do with the client is to say, okay, there's a first-time home buyer, or there's a home buyer grant in Pennsylvania, the state of Pennsylvania, that helps buyers with up to 5% of the sale price as a secondary interest-free, no payment loan that's added to the total financing. Doesn't cost the buyer anything as long as they stay in the house a certain period of time. There are qualifying requirements for that in terms of household income, credit score, and total assets that they have. That's one of the things. Frankly, you can borrow up to 102% of the sale price of the home. It has to be the right situation. They have to fit in the loan and the program parameters. But I sort of talk the clients through those options. There are some programs in the city of Philadelphia that are really nice, Montgomery and Bucks County, Delaware County, areas that have their own special qualifying programs to help buyers with home ownership and achieving that home purchase. So that's a big part of what we do, is to walk them through, okay, your income is in this range, your credit is in this range. Let's see if we can get you this grant program to help you with your buying power. So I think that's the fun part, is when we sort of find money. Like, hey, I know you didn't have any, it looked like you thought you couldn't do it, but we have this program over here that I think we can. I think we can get you into the house, and that's going to put you in a really good spot faster than what you thought. And so that really is a big part of that whole consult, looking at the big picture to say, you might think you're not ready, but by the way, what if we pull this down and now we have this option for you? Some of the first-time home buyer programs will connect them with the different resource companies that do the training for first-time home buyer ownership, things like that. It's good stuff. It's good education. It helps them understand what they're doing, and it helps, frankly, get them some funds for their purchase. Yeah, the short answer, yes, there are a lot of programs available. They just have to fit in the right parameters to qualify for that.
And I think that's the importance, again, with working with someone local that understands the market and what might be available to the buyers. Because if you're calling a 1-800 number to get your pre-approval and that person is sitting in, Mississippi or wherever, they don't know that what Pennsylvania is about and what programs might be out there. So that's, again, another plug to go local when you're shopping for lenders to help you in this journey, which is a really important piece of the pie.
A big piece of that, what you touched on, is when we've done those loans, that you're nervous going through the first time you do anything, but we've gone through it. Tabitha, you've helped hundreds of people find homes. You've gone through the process, so you're not as nervous about it. I've helped thousands of people with their financing. I've walked them through that path. So I'll light the way. Follow me. Come with me. I know the ins and outs of how do we get around this as a possible concern. Follow me. I'll light the way on that. And what I think is also important is the listing side. When we've worked in this community, if I've been doing this for 20 plus years, I've worked with a lot of agents on both buy side and sell side. Prosperity has a fantastic relationship and reputation in our marketplace. And I've worked with so many folks that a lot of times, the people on the other side of the table have been on a transaction with me before. And so that gives us a little bit of an advantage when you submit an offer to that agent and I call them and say, hey, Zach, it's Jake again. I know we worked on this deal and this deal. I have another one for you. Yeah, it is FHA, but trust me, I've already verified this. You can count on me and my word that we're going to get them to the finish line. Zach, you should take our offer over somebody else's. And there are a number of cases where I know the offer was accepted because Prosperity and
I acknowledge that. Yeah, there's been plenty of times that your name and the backing of the company has gotten us the offer, which again, some people don't realize the importance of that. And there's a lot of agents that do not realize the importance of the lenders that they're referring out. But I work with Jake because Jake always delivers. If he says he's going to deliver, he's going to deliver. He's not going to let me down at the closing table. He hasn't yet. Where we've had some other lenders do that, but it's because he's completely verified the client. He hasn't approved all my clients. He hasn't, but there's a reason why he hasn't. And it's so that there's no surprises when we get to the closing table that we can't follow through on a transaction. And that's important for all parties, right? Like my reputation, the lender's reputation, the seller who's selling their house thinking that they're going to be onto their next journey, and then all of a sudden it's crushed. So it's an important piece of the puzzle. And Jake picks up the phone at 11 o'clock at night. We've spoken at 11 o'clock at night, I'm sure, trying to tie up some financing. So he works like I work in a very similar manner where we work our best for our clients, and that doesn't have a time from 9 to 5. Unfortunately, it happens at all hours of the day. So that's why I truly value Jake. I call him Jake the Great, because he really helps my clients get what they want and what they deserve when they've worked that hard. So thank you, Jake.
Thank you, Tabitha. I really appreciate it. And honestly, I say this, but I grew up in a big family. Family has always been very important to me in terms of working together. We can find a solution, we can find a way, we help each other, and we help each other get to what we want to do next. So being a part of your team and your family it's an honor. And for me, it's fun to work with somebody who's got so much energy and brings a positive attitude to the whole equation. We've had some tough clients to work through and some tough challenges with different transactions. And honestly, Tabitha, your enthusiasm and your stick-to-itiveness is just unbelievable. And what makes my part of the job fun is because I know you're fighting as hard as I am to try and get this to work. So it's an honor to be on your team. Yeah.
Well, listen, thank you, Jake, for joining us and sharing that great information. I mean, Tabitha, obviously, thank you as well. You could see the heart behind all of this, right? And behind what you guys want to do and how you want to accomplish. And so it's been a lot of information, and obviously there's a lot more. So I also want to thank all of you listeners, viewers, for tuning in to another episode of Keeping Tabs. If you found it helpful, please share it with a friend who's thinking about buying. And don't forget to subscribe so you don't miss out on future episodes where we are keeping it real about real estate. And if you're wondering what loan might be right for you, schedule a no-pressure consult and let's talk about your goals. Thanks for tuning in.
See ya.